Good morning, everyone. Welcome to LSEG. I'm Balbe Bakshi, the Group Chief Risk Officer and member of the executive. We're delighted to be hosting this Reuters Newsmaker event here at Paternoster Square today. Won't bore you with too much detail about LSEG, but you hopefully got a glimpse from that video that we are quite a broad global financial market infrastructure and data provider. And given that broad mandate, we work very closely with our regulatory colleagues to achieve the common goals of financial system integrity and stability. So it's particularly special to be introducing this session today. We'll be hearing from a true leader in European economy and monetary policy, Philip Lane. Philip is the Chief Economist for the European Central Bank and has been a member of the ECB's Executive Board since 2019. As Chief Economist, Philip is the central architect of ECB policy and responsible for preparing the Governing Council decisions. With the support of a large team of economists, he is the first person to intervene during Board of Governors meetings and is responsible for proposing monetary policy options every 6 weeks when the board convenes to discuss. Based on these proposals, the ECB Governing Council takes the monetary policy decisions and sets the key interest rates for the euro area. And as you would have seen just this month, the ECB announced to lower interest rates for the first time since 2019. Philip was the key architect of the ECB response to the coronavirus pandemic and the post-pandemic inflation surge, two of the biggest challenges the bank has faced in the last quarter of a century. As governor of the Central Bank of Ireland, a role he held from 2015 to 2019, he led the response to some of the key challenges to the Irish financial crisis. In his copious spare time, his research interests include international macroeconomics, European monetary economics, financial globalization, cyclical behavior of fiscal policy, and the Irish economy. His expertise is highly sought after. He was a research fellow at the Centre for Economic Policy Research, a visiting scholar at the IMF and the Federal Reserve Bank of New York, and a consultant to the European Commission. His deep economics expertise is a credit to the ECB, though I doubt we'll ever hear him admit that. Philip was once quoted as saying, "We have to be conscious that the world can change quickly and that we need to express our humility in the face of uncertainty." And that certainly resonates with me, as uncertainty and change is a key focus for LSEG given our global reach. So I'm looking forward to hearing Philip's perspectives today. He'll be interviewed by Balazs Koranyi, a chief correspondent and 20-year veteran of Reuters. Balazs has been covering the ECB in depth for nearly a decade. Prior to his post in Frankfurt, he worked in Hungary, Norway, and Australia, writing on a wide range of topics from street riots to Arctic oil drilling and covering some of the world's biggest breaking stories. He joined Reuters after leaving a career as a professional runner and saw him compete in 2 Olympic Games. So quite the CV from our participants here today. We're all looking forward to the conversation, so please welcome Balazs to kick us off. Thank you.
Good morning, everybody. Philip, thank you so much for being here. Let's kick us off with a question about inflation. So after your rate cut, everybody wants to know what happens next. When does the next one come? The question I have is about disinflation. What gives you confidence that disinflation is still ongoing? We've had relatively quick wage growth, quick inflation, services inflation is high. So if you add that up, what gives you the confidence that we're on track?
So I think it's very important to remember what our goal is, which is to hit 2% in the medium term. And so basically decision-making, the most important element of decision-making is, do we have the kind of foundations for believing that next year in 2025, inflation will be basically materially lower than this year, and in particular, we basically have inflation at the target in the second half of 25, which is more or less 1 year away. And 1 year, 12 to 18 months, which is literally the second half of next year, is essentially the kind of response time of inflation and the economy to monetary policy. and we have inflation at 2.1 in Q3 25, 2.0 Q4 25. So what we need to see is, for example, we have inflation 2.6 in May, and we need to be able to explain and understand what are the mechanisms to bring that down basically by around 60 basis points over the next year and a half. Number one is there's mundane issues. This year, so in late 22, European governments introduced a lot of fiscal subsidies. They had to respond quickly and forcefully to the scale of the increase in energy prices. They did, and that would have suppressed inflation at that time. This year, they're reversing those measures. So every week, every month, some country in Europe is saying, okay, now we reinstate that VAT level. Now we cancel that subsidy. So there's a significant amount of that 2.6 at the moment, which is basically a level effect. It's the reversal of those fiscal measures. There's some of that still next year, but a lot less. So that's pretty basic. We have a lot of confidence that that fiscal effect is in the data now. It won't be in the data next year. Wages, yes, we are seeing in some countries significant wage increases now. But those exact same deals, the contracts that are signing are basically have a big negative slope. They're saying this year there's a significant pay increase to catch up on the surge in inflation. But next year, because we believe inflation is going to be more or less a target, the pay deals for 2025 are much closer, if you like, to steady state. So mid threes, there's a lot of threes in the wage data next year. There's a lot of fours and even more than fours this year. So we have a lot of confidence in that. Then we also have this year, the economy, we think is starting to recover, but it's recovering after 5 quarters of basic stagnation. So the spare capacity in the European economy, which we do think means the kind of new inflation, if you like, new cost pressures are going to be pretty muted next year. So we have pretty big platforms for the transition from 24 to 25. What we've also been saying is month by month, we can see bumps. But these are kind of, it's not about the destination. There's a fair amount of confidence about the destination in the second half of next year. But if you ask me, okay, tell me the month by month profile of inflation the rest of this year. And one thing which is important from that is, because sometimes the question is expressed about what do you need to see in the monthly inflation number to move on. And the problem with being overly sensitive to the monthly inflation number is these one-off effects, these level effects, and so on. So we do have to interpret the incoming data carefully, but to differentiate the noise and the signal, which is, I suppose, always going to be the issue.
Fair enough. You said inflation is going to be bumpy. But what is the unit of measurement of bumpy? How do we know if this is too bumpy or exactly the way you expected it? What should we see in the numbers, and how should we read the numbers as they come in?
Yeah, so this is, I think, a very interesting question, because there's a curiosity, which is, for whatever reason, in Europe, there's a lot of attention to the flash release. So at the very end of the month, at the start of the following month, the flash release comes out. The flash gives you the headline. It gives you the big aggregate numbers like services, goods inflation. But we need to wait for the details. So my view of the main inflation is going to be much more informed in the next few days when we get the granular May data. So basically the answer is we have to analyze those bumps. Is it kind of a one-off effect? Is it something super seasonal, like package holidays or something like that? Or is it something saying, well, actually, hold on a sec here. That component typically, if inflation goes up, it stays up. So it boils down to persistence. And that's, I suppose, by definition, a bump is a little bit up, then it comes down. That's a bump. Something that's a jump. So jumps we don't like. Bumps we can say, well, that's not going to last in the data. So this is why we have very good, you mentioned in the introduction, we have a very strong team. They're very strong in kind of diagnosing. And in Europe, it's complicated because we have 20 countries. This is why we need a euro system. We need the national central banks. If you quiz me on the details of kind of pricing of medical services in France versus something going on in the tourism sector in Spain, it's very important that the national central bank saying, well, here's how to think about that. So if I come back to it there's no knee-jerk reactions to the hyper-aggregated numbers, not a good idea. We need to be tough on ourselves because there's a temptation to say, well, it's just a bump. So I would say we know we shouldn't be complacent, but in the end, it goes back to do we have a good story, a good narrative to differentiate the bumps from the levels.
A key concern seems to be domestic inflation, which is driven by wages. So the question I have is, what do we need to see in services inflation, or what do you need to see in services inflation to feel comfortable that the disinflationary story is intact?
So I think, let me first of all agree, domestic inflation is a very natural focal point because that's what responds to us. So there's always external influences on inflation, which sometimes are unhelpful, like a big increase in commodity prices. But sometimes it's a windfall. If there's a big decline in global goods prices, inflation comes down more quickly, but it's external to us. So we do have a big focus on domestic inflation. Let me say, of course, there's a correlation with services inflation, but we need to also maintain the distinction because the goods component of inflation, there is a domestic component. Even for goods that are manufactured elsewhere, the distribution of those goods to their final customer, retail, shipping, transportation, there's a lot that goes on that is domestic in goods inflation. And in services inflation, we also have to remember, yes, a lot of local consumption, but if you look around, we know there's a lot of services exports. So tourism, in particular, there's a lot of non-Europeans who are, like to come here for tourism reasons. So that's a kind of a set of qualifiers. But what I would say it's fair to say is momentum at the start of the year in services was relatively high. So I think this is an example where we need to see the momentum come down in the second half of the year. So I've said to you lots of reasons why 25 versus 24 should see significant. But, of course, the starting point matters. The level of inflation this year still matters because if you subtract a given amount of disinflation, of course, this year's inflation rate shouldn't be too high if you want to get to 2%. And what I would say, it happened last year, the second half of the year, there's a lot less momentum in services inflation. And I think for me, that's going to be important, is to see, because essentially part of it was, some types of services like insurance, it's concentrated at the start of the year. They do price increases at the start of the year for administrative reasons or because some regulator has to approve it, and they approve it as of January 1, you can do this. For tourism, they set prices before the summer, and there's less momentum later on in the year. So I would say for services inflation, looking at the momentum, the 3 months and 3 months seasonally adjusted, those kind of measures will need to come down in the second half of the year.
Well, we're looking at a bumper tourism season this summer. We have the Olympics. We also have Euro 2024. Those, some estimate, will add a little bit to inflation. So can the momentum behind services inflation actually slow given this summer?
Well, this is very interesting. And you managed to say all of that without saying Taylor Swift. But a lot of this is June and July. So if you look at the tourism indicators, actually, I think it's strong, but it's not as strong as last year, and it's not as strong as the year before. So there is a downscaling. There is a moderation. And we have to remember, so last week I published a slide deck you can see on the ECB website. And what I showed is a lot of indicators compared to their 2015 to 2019 average. And by and large, with a lot of the PMIs, they're recovering to typical numbers for 2015 to 2019. That was a period when Europe was growing, but it was not some kind of overheating, bubbly economy. It was basically a moderately growing economy. So we should also remember our expectations here. We want the economy to grow. We want tourism to grow. We don't expect services inflation to be 2% because other factors will be below 2%, like goods inflation. So, it all compares to what is a reasonable steady state, if you like. So if I, honestly, with tourism, if I thought it was kind of at the same level as last year, that would be, or if it came out, that would be significant. But what I'm seeing is still growing. There is a kind of expenditure shift towards services, but it is not the same as the last couple of years. And over time, supply improves, because obviously people have been making money in tourism. So supply improves, new hotels opening, more capacity in transportation, and so on.
You mentioned inflation should be back at target by the fourth quarter of next year. Some colleagues on the Governing Council have sort of said that that's the limit. It cannot slip into 2026. And even the president has highlighted this number.
Yeah.
Is this a significant time frame? Do you think it needs to hit target by then? Can you tolerate any more slippage?
So let me say a couple of things about this. And definitely in making our June decision, we did go back, and I elaborated on this in the speech last week. We did go back to what did the world look like in September 23 when we made the hike to 4%. And then compared to there, where are we now? And essentially, already, by the way, even in late 22, inflation was 10.6 in October 22. Our December forecast basically said a lot of that will melt away in 23. But in September 23, because last summer we had a big increase in energy prices, there was a lot of repricing of medium-term inflation risk. So the environment in September 23 was still quite a bit of a upside risk perceived in the market, and the level of inflation was still quite high. But we did have inflation coming back to around 2 in late 25. Then in the December forecast and the March forecast and now the June forecast, late 25, inflation around 2. So that is a very stable vision. But what's happened is the transition towards that, it looks a lot better. Because in September 23, we had inflation this year still being relatively high. We kept on saying inflation too high for too long, because it was going to be fairly elevated inflation and then moving down quickly. We still have, so the departure from 2% now is smaller, but we still have a kind of a flatlining this year to some extent and then jumping down. So the issue is right now, what I said earlier on, this is 12 to 18 months away. It is very natural for us to say at that horizon where monetary policy can respond to it, we should be targeting that. Now, you still need to do the qualifiers, which is essentially, based on what we see today, that looks fine. If later this year or early next year there's some big surge in energy prices, it would not make any sense to say we need to kind of squeeze the economy to still hit. So it's not an unconditional statement. But if you say, based on what we see today, should we be setting monetary policy to deliver inflation around 2 in late 25? Yes, we should. But, of course, new shocks could arrive. And then the other important point is sustainability. We try and say sustainability all the time. Because, of course, if you hit 2% in late 25, we have like 1.4 in the projection for 26, or something really well below 2%, then that's not sustainable. So we need it to be sustainable, so that the vision throughout the horizon, and this is not new, by the way. In 2021, when we did a strategy review, the forward guidance that came out of that basically said we want to see inflation around 2, basically in the middle of the projection horizon, and then keep at it. That more or less remains. in the 1 year out, a year and a half out, we want to be a target, but then maintain it. So I think that's the way to think of the medium term is ideally we don't spend very much time away. And also I think you've heard from many of my colleagues, we don't want to be kind of overly driven by a few basis points. So I say around target in the second half of 25, 2.1 in Q3, 2.0 in Q4. So saying Q4 at 2.0, but for me, if it was like 2.5 in Q3 and 2.0 in Q4, not as comfortable as what we have is 2.1 in Q3, 2.0 in Q4, around target.
You make interest rate decisions meeting by meeting, without forward guidance, without pre-commitment.
Yeah.
So let me ask you about July and then September.
Yeah.
How much information do you get before July? And more importantly, what is the quality of that information? Is the information that will come in before that meeting enough to answer the big open questions, or is it more likely to happen before September?
Okay, I'm happy to take on the questions. But again, in the introduction, you were talking about uncertainty. And I think, I'm not saying we're amazingly good at it, but the whole world, including media, the markets, do have to kind of think about what the word likelihood likely means. How do we think about likelihoods? How do we think about distribution of risk? How do we think about 19 uncertainty? So I think whatever I'm going to say now is, if you like, kind of what kind of states of the world might we see? So it's not a kind of a bet. I'm not going to go into a bookmaker and make a bet, which is where likelihoods could get expressed. So what I would say is the July meeting, we will have June inflation data, the headline, the kind of raw data. We'll have the granular May data, which in my world, that's an exciting time next week when the granular inflation data come out. But what I would say is we do design the non-forecast meetings to have a lot of survey data. So we're going to have the bank lending survey. Now, on banks, what we've seen this year is essentially credit stable. It's not growing. So with the ongoing stagnation of credit in Europe, we see that in the monthly data. But it's always interesting to listen to what the banks are saying, especially about their customers. Because what they were saying last time was their customers are still not that interested in demanding credit, either households looking for a mortgage or firms looking to fund investment. So that's an important signal about the real economy, which I think is important. We're going to have the corporate telephone survey. So we have this maybe archaic phrase, the telephone survey, because I'm not so sure the telephone is the only way we communicate with firms. But that's always been super interesting. And coming back to what we talked about earlier on with wages, we do find it very interesting to hear directly from companies about what is the wage pressure they're seeing, but also what they're willing to pay. Because they look, they're still looking for wage increase. My revenue will not permit me to make a significant pay increase. So what they were saying last time is they do think wage increases this year would be significantly lower than last year. And we think this is important. And we also, I think, have the SAFE survey. We've expanded this survey on access to finance of enterprises. And so the corporate telephone survey oversamples very large, successful firms. The SAFE has lots of SMEs. And the inflation expectations of SMEs, their access to finance would be very important. So what I would say is the overall narrative, do we have a narrative about how the economy is working? Do we have a narrative about pricing dynamics? All of those would be quite important. But what is fair to say is what I signaled. The momentum in the services inflation, we're not going to know a lot more, especially when we have all of these spectacular events in June and July in some parts of Europe. But then, of course, every meeting is live, because going back to likelihoods, I cannot tell you around the world what geopolitical events are going to happen between now and July and so on. So it's always the case. We always have to be And this is why the meeting by meeting is not just about, given what we know now, the exact timeline of what we need to do. That's one type of uncertainty is, based on what we know now, what is the reasonable speed of making decisions about rate cuts? But it's also, we don't know how the world is going to change in these weeks. And so the meeting by meeting, I think, is a very good idea to signal the humility that we want about let's not, because it's very hard. People in this room probably are, very focused on conditional statements. But to a lot of people in the more general public, they sound unconditional statements. If you say, I'm going to do X amount of cuts and so on.
Last week you said that uncertainty was high, and one way to deal with uncertainty, high uncertainty, is by waiting a little bit. Can you unpack that statement? What do you mean by that?
So the context where I made that was exactly explaining why we waited, because the big improvement in inflation was actually going from September to December last year. The autumn was much more benign than was expected. So the kind of decline, so the big decline in the 2024 inflation projection and indeed the outturn for 23, in our December meeting last year, we'd already seen a lot. But we basically said, okay, that looks a big improvement in the forecast, but let's wait and see. Let's wait for March, and then we said in March, basically, let's wait until June. Let's build our confidence by seeing this scenario reconfirmed in another couple of projection rounds. That's basically the wait and see was there. Right now, what I basically said is that some of the questions we have will not resolve immediately, like the momentum in services inflation. So I think we do need to wait on that. But again, with the qualifier, lots of other things in the world could happen which could turn out to dominate. But conditional on wanting to know more about services inflation, we do need more than a month of data to do that.
And speaking of lots of things happening in the world, we've seen quite a jump in spreads in the last couple of weeks, particularly for France. So question one on this is, how much is that a change in spreads? Are you worried? Do you see a significant risk to the European economy or the inflation profile from the rise in spreads?
So, there's a tradition, very good tradition in many systems where central banks try to avoid making too many comments during an election campaign. Of course, there's elections all the time in Europe, so let me speak at a European level rather than any particular electoral cycle anywhere. Markets, of course, need to assess whatever future governments decide. We, unusually for a central bank, in our monetary policy statement, we always have a fiscal paragraph. So in our fiscal paragraph in June, we had some messages for all European governments, whether a current government or any future government. We want to see pro-growth policies, so we encourage a lot of reform. Europe needs to grow quicker. We want to see more European, if you like, infrastructural policies like banking union, capital market union. We need to see the green transition supported. And we need to see the European fiscal framework implemented. And so essentially, my view is that these are what the European Central Bank is very interested in. And any government anywhere, I think we want to see all of that on their implementation list. So, of course, in any election campaign, the market is trying to assess how every configuration of the outcome might affect any or all of those agenda items. But for us, all governments in Europe will need to have plans later this year. It's not immediate, it's later this year. They will need to explain how they are going to basically implement the new fiscal framework. The European Commission will be judging that. There'll be an interaction in the autumn between governments and the Commission. So there's a well-defined institutional setup here, and I think the Commission has an important leading role in assessing the fiscal plans of any government in Europe.
I mean, given what's happening in France, at least some pundits have raised or started to talk about the possibility of the ECB needing to use the TPI, the Transmission Protection Instrument. But my understanding of TPI is that it's not there to tackle a market event caused by domestic political issues. So just run me through the logic, what could TPI be even relevant in this case?
So again, I'm going to try and rephrase your question because it's maybe, I'm happy to talk about TPI. I think it's very important of TPI. I was very involved in the design of TPI. So let me come to TPI in a minute. But before I get to TPI, let me just again say this is about Europe in general. It's not about any one particular episode that you might see. So TPI is super important for monetary union. And, I've always basically had this view, is also relevant in the design of PEP in March 2020. And essentially in a monetary union, there is not a single sovereign market. There's 20 sovereign markets. And so a very fundamental part of how the European financial system works is the pricing of sovereign debt. There's inherently more fragility in the European system because you can obviously trade out of one sovereign into another sovereign if you get nervous. So it's very important that the ECB makes clear that we will not tolerate unwarranted and disorderly market dynamics that would pose a serious threat to the transmission of monetary policy. We cannot have a case where essentially market panic, market illiquidity, market sentiment disrupts our monetary policy. So it's in the description, and by the way, the press release we put out in July 22, really gives a lot of detail about the conditions and also how we would, think about it. But let me focus on disorderly dynamics. And essentially, there's, as you say, there's a fundamental difference between the market repricing fundamentals versus disorderly dynamics, where essentially the market becomes illiquid for classic Keynesian reasons. People are selling not because they are reassessing fundamentals, but they're selling because other people are selling. They fear being the last holder of an asset. So what we're seeing, I think, in the markets is, of course, a repricing. It's but it is not the world of disorderly market dynamics as of now. But of course, we have a very good markets team. We're always going to be monitoring, but I think everyone will be able to tell the difference between a disorderly scenario versus some kind of fundamental-based repricing.
How do you tell the difference? Where's the threshold?
Yeah, I know, but that's why it's very important that the Governing Council is appointed for its wisdom and judgment. So we are not going to give a mechanical formula because it would be kind of so many. For any formula you might think about, I can poke holes in it pretty quickly. So you will have to trust the judgment of the Governing Council on doing this.
ECB Vice President De Guindos last week said interest rates should come down very slowly. The market is now pricing between 4 and 5 rate cuts through the end of next year. Is that consistent with very slowly? Are you okay with the market pricing?
So I think there's a couple of very interesting and very fundamental factors behind using that phrasing. Because you might agree with me, going from July 22 to September 23, in basically 15 months, we did 10 rate hikes. We moved the rates by 450 basis points. Compared to that benchmark, anything we're doing is going to be very slow. So I think it's important, and I think it's important because, of course, we haven't been through a full interest rate cycle for a long time, if ever, in the ECB. And so, and again, compared to doing 450 in 15 months, that's number one. Number two, and many people have been writing about this, I mean, the ECB is only 25 years old. Not everything that could possibly happen in the world has happened in those 25 years. So the fact that some previous rate cuts were in the context of a crisis scenario or looming recession doesn't mean these are necessary conditions to cut rates. But what is absolutely true around the world is if the economy is growing, the kind of acute urgency that you need to cut rates to avoid a big recession, we don't have that. So we're talking about essentially initially, dialing back the initial level, the amount of restrictiveness, which for me, I've said before, this year, and I don't think I was specific about whether that's calendar year or the next 12 months. This year the initial phase is about remaining restrictive because we still have above target inflation and open questions, especially about domestic and services inflation. And then later on, it will be kind of searching for the new normal, if you like. But again, I think fundamentally the issue is, I'm a macro person. In our macro models, essentially, the big elements of this are quarter by quarter. So moving things around within a quarter between one meeting and the next, moving things around, I think you have the correct, if you like, horizon. It's not about what happens in 24. It's what happens this year and all through next year, and of course then the market anticipation of that. So what I said last week in a speech was our baseline, the forecast has us back to target in the second half of next year. That baseline is based on the market yield curve. The market yield curve at the time when the staff did the June forecast. If the world, if inflation is not coming down as quickly as we would like, or if the economy is stronger than we expect, then we'll go more slowly. Conversely, if we get welcome surprises on inflation, or the economy weakens more than we expect, we'll move more quickly. So I think that describes the reaction function. The likelihoods, that's the market job. I don't spend that much time thinking about likelihoods because we can change our mind every 6 weeks. The market has to make a probability-weighted decision. I don't. So I'm going to go meeting by meeting, and I really do not spend much time trying to say, is the baseline like 85% likely, 80%, 51% likely? I don't, because it's not a productive use of my time.
Where does restriction end? I think it was uncontroversial that moving from 4 to 375, you're still in restrictive territory. At what level does the debate start?
So I think already it's interesting, and I would say, and I think we're all trying to say the same, which is, of course, it's very interesting to think about R star. First of all, there's a zone of uncertainty around it, but there's probably deeper is if the relevant fundamentals move, then our assessment of restrictiveness moves. So I think for me, the list would include what's happening to credit. So if credit begins to pick up, we do expect credit to recover. So we want credit to recover, but at the very least, it's not going to be much of a debate about restrictiveness if credit is stagnant. Consumption and investment behavior, we want consumption and investment to recover. But again, if we see it, the kind of 0.4 Q&Q we have for the economy for the next year and a half, that's already quite a lot of growth in Europe. So if we see essentially demand picking up more than we expect, that would essentially say, well, okay, if it's more than we expect, maybe one reason is financial conditions are not as restrictive as we think. So I would say it's an inversion. It's not saying, here's our number. We'll invert it from what we see in credit and real dynamics. So, so it's not really a separate topic to just general decision-making in monetary policy, which is real dynamics, credit dynamics, and of course inflation dynamics. But what I would say is 375 is quite some distance, I think, from where this debate would really heat up. So, it's important, but it'll be more important further down the road.
I have one final question before I start the audience Q&A. Of course, I hope you have some questions. If you don't, I have plenty, so I can keep going. But I want to give you an opportunity. But let me ask you about Fed policy. In the past, when we spoke, you seemed not so concerned about divergence between the ECB and the Fed. Last week, we saw the Fed move the dot plot quite significantly. So does that change your thinking? Do you think the divergence is more of an issue now than it was a little while ago?
I would say no. And of course, we also had inflation data in the US last week. And even if you look at the dot plot, there's a pretty even distribution. So the median, of course, is highly sensitive to one or two votes. But what I would say, there's a range of opinion in that dot plot, as opposed to being a big kind of movement in the distribution. But fundamentally, I do find this a very curious question. We have a continental-sized economy. We do trade with the world. The exchange rate matters. Arbitrage between the dollar and euro-denominated bond markets matters. But essentially, ex ante, you have forces moving in opposite directions. So in expectation, it's hard to build a scenario where it's super important. And this is why I say it's basically an empirical issue. If we saw a really big movement in the euro-dollar rate, not a tiny movement, a really big movement, then it might be relevant for the inflation forecast. We think exchange rate movements play out over several years. Some sectors might reprice quickly. Other sectors, it's years down the road before a movement in the euro-dollar rate matters. So any given, if you like, total impact, if you spread it out over 3 or 4 years, the impact on the inflation rate in any 1 year becomes fairly small, unless you have a big movement. And in the past, there have been big movements. My favorite big movement is mid-2014 to mid-2015. So as it became clear the ECB was thinking about QE, the euro-dollar rate moved from the 1.4s to the 1.1s or whatever it was. That's a big movement. 108.05 to 108.01 or 10, these are not big movements. But if it happened equally in the term premium, if there's a big spillover from the long end of the US dollar market, a big one, into the term premium, this would matter. So we're looking at all of this. But it really is the case, we have multiple opposing forces, so it's not a kind of universal message. But let me come, I think, to probably where the more interesting thing is. It's not about Fed policy, is we're all trying to learn about basically how quickly does inflation return to target. You have one laboratory, which is the US, you have another laboratory, which is the EU area. So, I think that's more interesting that is what is there in the kind of inflation surprises up or down in America that we can say, okay, that's interesting. With that kind of, I've learned something about inflation dynamics from that. How much of that might show up in the European data? That is a fair debate. And so earlier in the year, there was upside surprises in the American data, but we also had a pretty strongly growing American economy, which we didn't have in Europe. We've now had a bit of a downside surprise in the US inflation data. So let's see.
Right. Here's your chance. Question in the middle. I think we're supposed to have some microphones. It is coming right away.
Thank you very much. Julian Cano from Rocos Capital. So I'd like to maybe ask a bit more about monetary transmission. Obviously, you have these three aspects of considering monetary policy, and monetary transmission is part of that. Now, inflation is, as you said, coming down. So in a sense, that means that there should be a focus on real interest rates. Also, people are interested in the speed of monetary transmission and whether we are past the peak effect now. So in terms of how we think about future restrictiveness, it would be interesting if you could elaborate a little bit on your current thinking concerning monetary transmission. Thank you.
So let me take on this peak effect element. So it's important to differentiate between the peak effect on the economy versus the peak effect on inflation. Because we did stop hiking, in September. We do think the peak effect on the level of GDP is probably behind us. But and that's another way of saying the European economy is starting to grow again. We don't think the peak effect on inflation dynamics has happened, because there's a number of lags in that. Basically, if you think about our basic inflation models, the amount of spare capacity in the economy influences the ability to raise prices. And the amount of spare capacity in the economy is a function of the cumulative shortfall compared to potential output. And we do have, I think, a significant spare capacity now in manufacturing, especially in other sectors. So we do think that the impact on inflation is still strong. By the way, we're doing a fair amount of work trying to show how prices in different sectors are sensitive to monetary policy. And of course, in kind of durable type sectors, the pricing is essentially front-loaded. Because if you want to convince people to still buy, durables, you really have to kind of keep your prices attractive. Whereas in services, it tends to be backloaded because, as we were talking about earlier on, the wage increases now have been delayed in some countries. But because services aren't sensitive to domestic demand, to domestic monetary policy, another way of saying the reason why we think inflation next year is going to be a lot lower than this year is part of that is the ongoing impact of our monetary policy decisions will keep on lowering inflation into next year. One very basic reason is there's a lot of backward-lookingness in European wage data. So by having inflation relatively low this year, that lowers the wage increases next year, and in turn that lowers 2025 inflation rates. So I would say for inflation, we haven't reached the peak impact. I'd say also in Europe, because there's a lot of people in some countries on fixed-rate mortgages, even while we're cutting the policy rate, someone taking out a new loan will face lower rates. But the average interest rate on existing loans is going to be going up for a long time because they're going to be repricing compared to a very low interest rate when they originated the loan. So, it's a different debate in different parts of the world. But as we just talked about, we don't really have a debate in Europe that monetary policy is losing restrictiveness.
Sorry, in the middle, I can't see you. Yes.
Global Investment Research. I just have a small question. How do you reconcile QT and then easing monetary policy? That was my first question. And the other question is, we're seeing inflation sub 2% across Europe in some parts, in some countries. How do you manage that? Obviously, you're looking at the aggregate. So,
okay, very good. So I think it's very important that QE was kind of conducted at a time when the policy rate was at the floor or close to the floor. And so the launch of QE was definitely, if you like, to ease the monetary policy stance. But once you're away from the lower bound, you basically run monetary policy through the interest rate. So we're easing monetary policy because we think we're closer to delivering the target. So then the question is, what do you do with the stock of assets you bought? And what you want to do is wind it down in an uninteresting way. And that's essentially what we're doing. So I think we do have to kind of look at it, see is it affecting the yield curve, term premia, liquidity, all of that. So we do think it's interesting, but the basic answer is whatever we conclude from that will be one of the considerations in setting the policy rate. The answer to whatever we see is not either to speed up or slow down QT. Passive runoff is a very strong benchmark for QT in the euro area because we can always just basically modify the most efficient thing to do is modify the policy rate in response to whatever stance impact we see. So basically, in our setup, it's a background policy. And let me also just maybe connect it, because of course we did the operational framework review earlier this year. We have a very, because we're quite legalistic, I think it's actually helpful. So we have our stance policies like the APP and the PEP. And these are, so we're going to let these run off. We've also said if we need to in the future to implement monetary policy to make sure the system has enough money market liquidity, there may be a role for a structural bond portfolio in the future. But that's a clean and sharp distinction. Whereas, of course, in the US debate, you say, oh, they may need to slow down QT for kind of operational framework reasons. Because we have separate bond portfolios for different functions, and it's going to be a lot easier to communicate in Europe because whatever we need to do to operationalize monetary policy is a technical issue and will not be confused with the stance. So the second question, remind me. Okay, so we have an aggregation issue, but it's clear we only have one monetary policy. All we can do is target the weighted average. So in some countries, the forecast 2 years from now is inflation visibly above 2%. In other countries, it's inflation visibly below 2%. What I would say is that there's a limit to monetary policy, so the European framework needs to also say, okay, that basically means real exchange rates are moving. Some countries are losing competitiveness, other countries are gaining competitiveness. And then the national governments, the Commission, will want to take a look and say, okay, are those real exchange rate movements supportive? So they're fixing long-term imbalances, or are they amplifying long-term imbalances? Right now, it looks like there's a fair amount of that is essentially in the direction of improving imbalances within the euro area. So that's less tricky than some other scenarios where economies with already weak fundamentals are losing competitiveness.
Thank you. Mark John from Reuters. Looking at the June rate cut, there seemed to be an unusual consensus that a June rate cut was a done deal, not just weeks, but possibly even months before that happened. And that was looking at the kind of the overall communication coming out of the ECB, from the press conferences, from yourself, from President Lagarde, the other policymakers and so on. Is it a criticism that you would accept that the ECB in this particular case pre-committed too early on this one? And if that's true, how is that compatible with data dependency? And are there any lessons to be learnt going forward in, as you say, which is quite a long path through beyond into the future?
So what I would say, and essentially what we had was a situation was last autumn the inflation profile improved. So going from September to December, we had a significant improvement. And we basically said, this is welcome, but we want to be really sure that this is a solid improvement. And this is where the building confidence language came from. So in March is basically fairly stable forecast compared to December. And in terms of the medium-term component, this like end of 25, it is stable again in June. So essentially, same last autumn, because I mean, I think I said versions of this, other people said versions of this, is that basically this improvement is welcome, but we really need to see it reconfirmed. For example, we really need to see the wage data be consistent with this. And the conclusion in June was, we do have that. And again, the fundamental issue for the wage data is the evidence that 2025 wage increases will be a big deceleration from this year. So it's not the fact that at the start of this year, some indicators came in a bit strong. It's the evidence, because a lot of multi-year wage contracts and so on. So we essentially said, if our confidence goes up, that this improvement, which started in late last year, is reconfirmed. So this remains state-based forward guidance. If these conditions are fulfilled, then so I think that is reasonable. What would not be reasonable is to say, well, no matter what, next time we're going to raise rates or not raise rates. And we did say even in the April meeting, and I would have been comfortable, it might have been a bit awkward on the day in June if we said we didn't quite make it. Our confidence levels didn't quite get there. Even though 10 days out, I would have said, I don't see anything on the horizon. But I think central banks have to be willing to surprise the market if they need to. So I would say it's in the context of a significant move last autumn that we did not respond to. We said we need to wait and see, basically with 6 months of data in the end. But of course, on a kind of, because that was essentially, there's a break. The momentum, I mean, I think President Lagarde at some point had it's breaking the back of inflation persistence. When you have a turning point, and I think the turning point, a lot of it was last autumn. At a turning point, you do really want reconfirmation, double check. On an ongoing basis, we basically now have, a narrative that we think, and already it's backed up by the fact that inflation's 2.6 now. It's not 3-something or 4-something or 5-something. So we now have a narrative now of if the baseline pans out, we will be going back to target. And therefore, we will have a challenge to make sure that over time our interest rate looks more normal, not remaining restrictive. So in terms of what we need to see and so on, it is a bit different now compared to a pretty big jump. And I was personally last autumn, I remember the October meeting even, because we still had this phrase, inflation is set to be too high for too long. Because inflation being in the 3s, for example, or high 2s, it's really quite far away from 2%. But the deceleration we saw, even if it's not perfectly linear, it's not a monotone process. There are bumps. I do think this is a very important period. But again, it was state dependent. I know I've read people said it, I know about, well, going from March to June, there's some numbers didn't move in the right direction, but we were not going quarter by quarter. We were essentially saying, have we got enough evidence that we've had a turning point? And I think we did have enough evidence going September to June that there has been a turning point.
I think we're almost up in terms of time, but perhaps one last question, if you're okay. The gentleman all the way in the back on the right. Oh, never mind that. Then.
Hi, I'm Juanos from Fathom Consulting. I had a question because there is a heated debate of whether inflation is going to be structurally higher over the coming years. because you have some forces pushing to that direction. You have this post-COVID switch to services inflation, which is usually more sticky, and then you also have other forces such as a risk of deglobalization and also increasing geopolitical tensions, which can make these shocks feed through core inflation. Then, on the other hand, you have demographics, which is pushing on the other side. So where do you see the equilibrium in inflation in the euro area over the coming years? Or do you think that we are going back to, as we say at Fathom, back to BC, so back to before COVID, where basically you are at the zero lower bound and you have inflation at 1-2% max?
So I think there's a fundamental difference between upside risks and downside risks. Because what we had before the pandemic, and I think what we did for a strategy review where we looked back, was basically there's a very, the global financial crisis left a big footprint on activity levels in Europe, other globalization interacting. But with below target inflation, it's hard to reverse it quickly because of the lower band. If there's upside pressures to inflation, I would translate a lot of that to where's the interest rate going to be? Because essentially with upside risk, we can handle it. We just raise interest rates. So if you say, what is my prediction? My prediction is inflation at 2. Because if we see pressures above that, we just keep interest rates higher. So it's not about the outcome. The outcome, whereas if you have big negative shocks driving inflation well below 2, then we will respond. We will go to below normal interest rates. We'll go towards the lower band. But how quickly inflation recovers from that, there is a lower band. It matters. So the speed of convergence back to target from below is intrinsically going to be slower than the speed of convergence from above. You or anyone else in financial markets have to attach probabilities. I can change my mind every 6 weeks. So I do not spend time trying to worry about likelihoods across different scenarios. I'll respond to the events we see, the evolution of the scenarios we see, and keeping a focus on medium-term target.
With our time up, I would like to ask Rachel Armstrong, the European editor for Reuters, to say a few closing words.
Hi, everyone. I promise I won't keep you much longer at all, but I just wanted to give an enormous thank you to Philip for such an engaging discussion. Given that we're in the UK, I think many of us here in the room are having to listen to politicians at the moment give us day in, day out, perhaps less than clear picture of what fiscal policy will look like over the next few years. So it's very refreshing for me, and I'm sure many other people here, to hear such clear, cogent answers about the inflationary environment facing the Eurozone right now. And perhaps the honest response for the degree of patience by markets and economists is probably what is needed right now more than anything, given the uncertainty we're facing. Balazs passed me a few notes ahead of today's event, and one of which said that some of your speeches are so complete, thorough and well-founded that they would easily pass a master's thesis in any university worldwide. It felt like some of your answers today also met that standard. So I hope that everyone here enjoyed this Newsmaker event. They're organised by Reuters in partnership with LSEG. Other ones we've done recently include US Treasury Secretary Janet Yellen and UBS Chief Executive Sergio Emotti. I think this is the first one we've done, at least in the current format, in person here in Paternoster Square. So, Philip, you have set a huge bar for us, but I hope that we can see everyone again here very soon with an equally illustrious speaker. So, many thanks, Philip, and thank you, everyone.